Hello there, and welcome back to Retire Your Way with ILG Financial. My name is Chase Lopez. This is Dave Lopez, and we're both investment advisor representatives for ILG Financial.
Yeah, good morning to you, Chase.
Morning.
Today we're going to address a specific article that came out. We love this article as being illustrative of what we've been talking about with our clients for years now, of what was coming and that has now hit. And if you've been watching our channel, you may have already seen us do one video, thank you, Chase, on bonds and how the world is really changing now that we are moving into a rising interest rate environment, and now how that could affect how you invest if you're used to investing just in the old model of some in stocks and some in bonds, which in the past has worked because we've been in, what, 30 years?
Yeah, 40 years almost.
In a falling interest rate environment, that model works great.
Right.
But what this article talks about, what we talked about on the podcasts, and we've been kind of just ringing the Paul Revere bell for years.
Shouting it from the rooftops.
Yeah, as interest rates start to go up, what worked in the past may not work in the future. So a lot of times our clients hear it from us, but every now and then we get a chance to say, look, this is something you need to know. It's not just us saying that. So we're going to go through some of the highlights of this article, Chase. So it's titled, and we're going to include a link below to the article if you want to read the whole article. The title is Rising Interest Rates, Falling Bonds, and a Possible Way Forward. It's written by Kurt Fillmore, very well written, of the Investment Advisor. Again, the link will be below. And what he's talking about is if you've been having some angst about how bonds and your bond funds have been performing, maybe it's not how they have been performing in the past, you're wondering if it's a way forward, you're not alone. And in this example, he even quotes, he even says Bill Gross, who's actually known in our industry as the bond king because he's been promoting bonds for 40 years almost. That's been the past. Now his quote is, bonds, he says, belong on the investment garbage can. And what he's talking about is what we were talking about, that in a rising interest rate environment,
the value of your bonds actually goes down.
Your value of your bonds may go down. So if you're used to earning a 4, 5, 6% return on your bonds and have safety to offset your stocks, that may not work anymore. And he says for many people, they've been used to this, let's say a 60-40 split, 60 in stocks and 40 in bonds. And the bonds were a nice counterbalance against the volatility of stocks while still giving you a good rate of return. And he said, although that's worked in the past, it may not work in the future. And that's why other folks are looking for, and we talked about this before, didn't we, Chase? Bond alternative vehicles. These are investments that do what your bonds used to do for you. And by do that, I mean giving you a return that is a reasonable return. Think 4, 5, 6% is an ideal, is what you're looking for. But at the same time, safety from stock market risk. So a counterbalance from your stocks.
So just to jump in there, Dave, just to do a quick recap there for everyone, right? We are now in the middle of 2022, give or take, and with bonds, to your point, Dave, as interest rates go up, the value of your bonds goes down. So that's very important as we're moving through this discussion. And it's very different than what it's been like for the past 40 years.
Yeah, and a big reason is most folks thought they couldn't lose money in bonds. Right. They thought, I'm going to get a little interest and I may not make a lot, but I won't lose money. But what you're seeing here, and many of you watching today may see this, if you go look at your year-to-date returns on any of your bond funds or your bond holdings, you might see they are worth less than they were on January 1st because with higher interest rates, your bond's actually losing value. And if you cashed out of your bond or your bond mutual fund early, just like a stock, you'd lock in those losses. So this article is talking about bond alternative investments, which we've discussed several times, even on this channel. Today what we want to do is, following this article, give you a concrete example of a bond replacement vehicle. This is just one. For time's sake, we're going to talk about one, but we're going to be able to devote a little time to it, right, Chase? So the bond replacement vehicle that...
and sorry to cut you off there, Dave. Just when we're talking about bond replacement vehicles, right, a lot of people will say, well, what does that mean? And really what we're saying, all we're saying is these investments operate similar to how bonds used to work in that we're earning a reasonable rate of return and our principal is safe, right? Or at least safe based on whoever's issuing the bond, whether that be the government or whoever the case may be.
Somebody's giving some security.
Right.
But the third thing is, of course, it's protected from market risk.
Correct.
Your bond doesn't go up and down based on the market. So in this article, Kurt Fillmore, the author, talks about one possibility being a fixed indexed annuity. Now that's an annuity, but you'll hear on our channel, we talk about this other times when we give explanations of annuities. A lot of people don't know. There's 4 or 5 different types of annuities.
Right.
They're all very different, and that's for another video. But today, this particular type of a fixed indexed annuity can give you a guaranteed income for life if you want.
Right. And I think a lot of people associate that income stream for life with annuities, don't
they're
they?
thinking, well, this isn't for me.
Right.
I don't need an income for life.
Right.
In fact, I'd just like to get money when I need it.
Right.
Well, what Kurt's talking about in this article that most people don't know is a fixed indexed annuity can be used for an income for life if you ever need to or want to, but many people don't. They use it just for accumulation, to grow their money, just like you would in a stock or bond account or a 401k account, and then they just pull money out as needed.
Yep.
Right? And but it's protected from stock market risk.
Right.
So I'm going to give you a few highlights from the article. Chase, jump in if I kind of miss anything. It's a way to grow your money rather than providing guaranteed income if you don't need the guaranteed income. Investing in this manner means you don't have to lock into a fixed monthly withdrawal, right? And again, that's a misnomer for people, thinking that if they get an annuity, they have to get an income. You can just let this thing grow forever if you needed to.
Just like you would with any account,
Just like any account, right? Any account that's accumulation account, right? The advantage is, unlike the bonds, the principal and gains are protected and cannot decrease. And I want to emphasize that. Unlike bonds, your bond goes down in value if interest rates go up. A fixed indexed annuity's account value does not go down when interest rates go up. It does not go down when the stock market goes down. So it's protected from both stock market volatility risk. It's also protected from interest rate risk that bonds are.
And I think that's important for people to kind of think about in these new times, because to your point earlier, Dave, when people are looking at their statements and looking at these bond funds, this is probably the first time they've ever seen those accounts be negative.
That's right. So if you're wondering why you've never heard of a bond alternative vehicle like a fixed indexed annuity, and there are others I want to mention, is because you haven't needed them before, right? But now that we need them, if you're wondering, you're not the only one. Millions of dollars are flooding into bond replacement vehicles right now as lights come on and they realize, hey, I do not, as the bond king said, it's not going to operate the way it used to be. So I need an alternative investment for the money I want safe and not in the stock market.
Exactly.
And a fixed indexed annuity eliminates the risk from stock market volatility. But if the market does perform well, it gives you a chance to capture some of the gains, not all of them, so it gives you a chance for a reasonable rate of return without having the market risk. So it's an excellent bond replacement vehicle. And what we want to close this video with, just so you see, this isn't just us or Kurt talking. There's 2 specific studies that came out, and I will encourage you to check on those. You can get with us. We can even put them in the links below. The first one came out a few years ago. Robert Ibbotson came out with this report. He is an economist, and he went through a century worth of market results. He created a hypothetical model of how a fixed indexed annuity would have compared against a bond portfolio over this roughly 100-year period. So we're talking about a treasure trove of data to compare. And we always advocate, make your decisions based on fact and data, not by what someone told you at the water cooler at work or what your uncle told you of what works. Use data. And what we're giving you today is some data. So I'm going to give you the highlights of this particular study. Okay. So here's what Ibbotson found. Again, he's looking at how a fixed indexed annuity would have fared from 1927 to 2016. So that's pretty close to 90 years.
Yeah.
Chase. And here's what he found.
Oh, and that includes the Great Depression, right? I think a lot of people need to...
from 1927, it's 2 years before the market crash of 2009. but the big takeaway here is it includes several market ups, several market downs, and several periods of interest rates up and interest rates down. So it gives us a big enough sample size. Here's what he found. When his team of researchers looked into this and crunched all the numbers, they found that fixed indexed annuities had an annualized return, get this, 5.81% a year over that roughly 90-year period, compared to bonds, which had a 5.32% over that period. Now that doesn't seem like a big difference, and it's not a huge difference, right? But the point is that's over the long period when even when bonds were good, this thing still over time would have outperformed. Stocks, by the way, over that period would have averaged about 9.92% over that long 92-year period, which is why we're big advocates on the market for the portion of your gains you can leave in long term. He goes on to say, in some years when bond yields were especially low, think 2022, right? The fixed indexed annuity would have helped investors even more, right? In other words, get this, a traditional split, 60-40, of 60 stocks and 40 bonds would have done good over this 90-year period. However, if you had done a split of 60 stocks, 20 bonds, and 20% fixed indexed annuities, you'd have done even better. And if you had done a split of 60% stocks, 40% fixed indexed annuities, and 0 bonds, it would have come out over that roughly 90-year period, the best of the three. And that's the data you want to look at when you're making decisions. So do you see why folks are starting to, the lights coming on about bond alternative vehicles?
Yeah, and then in a more recent study that was by BlackRock, which is one of the largest investment firms really out there, they pretty much corroborated what Ibbotson had found. They had said, the main conclusions from the study said, adding fixed index annuities to a portfolio added greater upside potential than more average stock market return years. So if the market isn't doing as great, adding fixed index annuities to the portfolio adds some more upside there.
So we say it again. So what you're saying is, read that part again for me.
Adding fixed index annuities to a portfolio added greater upside potential in more average stock market return years.
Yeah, so it's saying if the market's just not doing, going through the roof, just average returns, the fixed indexed annuity gives you a little boost to, I would suppose, doing just the bonds.
Exactly. And then also, fixed index annuities improved outcomes in balanced portfolios during extremely bad market years. So in not so great years, it helped, and then in bad years, it certainly helped as well.
As a counterbalance, just like bonds used to do. That's why it's the bond replacement vehicle.
And then incorporating fixed index annuities can provide more certainty around future portfolio values in general. And they specifically pointed to, and we've done a video about this in the past on our channel here, but they pointed out the importance of sequence of return risk and how fixed index annuities help pretty much completely eliminate sequence of return risk, which is a huge risk for retirees as they get into retirement.
Yeah, and if you don't know what sequence of return risk is, look at our channel. We should have a video on there. I know we've had podcasts done. And if you don't want to do any of that, pick the phone up, call the office, and we will walk you through exactly what it is, how it affects you in retirement, and if it affects you in particular.
So, if you enjoyed the video today, go ahead and hit like and subscribe there at the bottom, and we'll talk to you soon at our next video.
See you next time.